Welcome to Retirement Optimizer's how-to videos to help you work through the program and plan your retirement. This video will work through step 9 of the solver, non-registered accounts. Non-registered accounts are taxable investment accounts that are not registered with the federal government. They are liquid and have no contribution limits. There are two primary types of non-registered brokerage accounts, cash accounts and margin accounts. Cash accounts are investment accounts in which income is taxable in the year earned if there are capital gains, dividends, or interest income. These accounts receive different tax treatment from registered accounts, so more information is required and some predictions need to be made regarding future returns. These details must be filled in separately for the retiree and the retiree's spouse. Canadian equity investments are treated differently for tax purposes than other investments. So we must distinguish between Canadian and non-Canadian equities, as well as fixed income assets within the non-registered account. However, the inputs are the same for each, so we will work through Canadian equities in this video. First, enter the dollar value of the account's Canadian equity, followed by its initial adjusted cost basis. This is the adjusted cost basis right now. For example, a sum of all the money that the retiree invested in Canadian equity, including dividend reinvestments if applicable. Then enter the percentage growth rate, which is the expected annual appreciation of equities expressed as a percentage, followed by the expected annual dividend yield of equities, also expressed as a percentage. The distributed capital gains refer to the capital gains paid out by a mutual fund, ETF, or other investment fund, and are taxed in the year they are received, even if there were no shares sold. Finally, enter the return of capital distribution of the account's Canadian equity, which is when an investment, like a mutual fund, ETF, or trust, returns part of the original investment instead of paying income or capital gains. If the retiree has non-Canadian equity in their non-registered account, these fields must be filled in separately for these equities, as well if they have fixed income assets in the non-registered account. These are investments that generate regular interest or income held outside of taxed advantage accounts, like TFSAs or RRSPs. Because they are in a non-registered taxable account, the income they produce is taxable annually. Next, enter the percentage of the account that will be bought and sold on an annual basis, as well as whether the account will maintain the same ratio of Canadian and non-Canadian equities and fixed income assets. Then enter the annual advisory fee on the account expressed as a percentage. This is the fee paid to the financial advisor to manage the non-registered account. The average advisory fee is between 1% and 2%. All of the above distributions are net of fees. Next, enter if a loan was taken out for the purposes of investing. This is a tax-deductible margin loan. If yes, then enter the annual loan payment as a dollar value and how many years until the loan is repaid. Finally, select if you want to exclude the account from the analysis. If the account is excluded, the value of the non-registered account remains as part of the net estate value, and this account is not used in the withdrawals. This account does not become part of the retiree's target income. Fill out the same fields for the spouse if they also have a non-registered account, and congratulations on completing step 9 of the solver.